The flotation cost is something we've alluded to, but let's deal with it explicitly now. Flotation costs is what costs are borne by the issuer of either a stock or a bond in order to get the financing into the marketplace. And so those could be quite substantial. It's for the underwriters, such as the investment bank that was employed, all the attorneys and accountants necessary for the offering, the SEC filing process and all the costs to take care of that, and all the rating agency if there is some additional fees necessary to be rated. So that particular flotation cost then would vary in dollar amount and in percentage because of the size of the offering. And the riskier the project, the higher those costs would be. Getting attorneys, accountants, and investment bankers and rating agencies comfortable with the credit is going to be more difficult if it's a very complex or borderline company. So when we issue common stock, there might be a signal to the marketplace that the company needs money. This would be a secondary offering. So let's say there's an IPO, and after a year, you're going back to the market. There might be some skepticism around that. However, if the story is told correctly, it could be seen as positive. We've deployed the IPO funds productively, been successful with it, and now we have opportunities that, again, outstrip our ability to generate cash, and therefore we're doing a secondary offering of common stock. So a lot of it is in the roadshow and the selling of why the company can justify the new stock offering. So the flotation cost, as you would imagine, would be highest for common equity because there's a lot of risk in the investment in a company. And it would be lower if it were for debt because we're guarding only against the risk of default in that particular case. And also there's a correlation between the frequency of going to the public markets. The more frequently you're going, then a lot of the studies and work can be relied upon for the subsequent study or subsequent offering, so the cost would go down. So it's a function of the risk of the issuance, where common's higher than bonds, or the frequency, where the more frequent, the lower the cost. And in the past, we've ignored flotation costs, and this section is to show what it would be if we wanted to add that level of refinement to our analysis. So let's start by looking at common stock. The top part of this should seem fairly familiar. Top part is simply next year's dividend. This is obviously a dividend growth model related. The second is the growth rate, which is the G, the plus G, and that's what we looked at when we determined the long-term growth rate. P0 is the price of the stock at the beginning of the period, and here is the adjustment. 1 minus F is the flotation adjustment. Flotation is a percent of the total offering that was the total of the cost. So if you raised $100 million in the offering, if the flotation cost, as it is in this case, is 15%, then it was a $15 million proposition to raise that money. The reason we do this calculation is that the company did not receive all of the funds. They received 85% of the IPO funds in this example. So therefore, we would then have that as the denominator because we didn't get $100 million, we only got $85 million, and that's why it's in the denominator. So let's try it with debt. So in this particular case, we can use it in Excel. It's a slightly more interesting calculation. It's issued at par, $1,000, and therefore the coupon equals the yield, 10%. Annual payment, just to make it easy, tax rate of 40, we'll need that for the tax adjustment, and a flotation cost of 2%. So we hop into Excel, we can then see what is the interest rate, and the interest rate is 0.1 because it's issued at par. And next is the amount raised, and that equals 1,000, but here's where we have flotation times 1 minus the flotation cost of 2%. So we only got 980, and the payments will equal the par value of 1,000 times interest rate, which is 0.1, but we're going to do this as an after-tax cost times 1 minus 0.4. So that's our adjustment, that although we make those amount in payments on a gross level, we also get a tax deduction, and we're taking benefit of that tax deduction here. and the term is 30 years. So now we're ready to go. The rate equals, so we'll use the function, Excel function, RTE, open parens. Number of periods is 30. Payments are 60. Let's do minus 60. And the PV is 980. That's what we get. That's net of flotation. The future value is 1,000 minus 1,000. And that's our answer, 6.15. I'll copy that over so you can see it better. And so the rate is 6.15. Now notice that it's quite different. We started at a 10%, and this is the coupon. And if we did after tax, it would be plus 0.1 times 0.66%. But the actual, there are several rates. One is the coupon rate is 10%, but there's taxes benefit. Well, if we only took into account the tax shelter aspect, it would be 6%. However, by adding the refinement of realizing we don't get the full $1,000, we get that less the flotation costs, adjust the interest rate to be 6.15. So it's a more precise measure of the cost of capital. Notice that we capture most of the difference with this one adjustment with taxes, and we're picking up incrementally a little more accuracy by considering flotation.